already started the live? Oh, okay. Hello, everybody. Welcome back to another Money Monday. I'm Imani.
And I'm Melanie.
And today we're going to be talking to you guys about credit and banking.
Objective. Today's objective is to know what banking is, understand the different types of bank accounts, and know what credit is, and understand how credit scores work. In the chat, can y'all do anybody know can y'all type a name in chat of any type of financial institutions besides a bank? Y'all can put it in chat.
So you said any financial institution other than a bank.
Yes. Okay. M&T. Okay.
M&T Bank is a
Yes.
but yeah. Good answer.
Credit union. Okay. Yeah.
Credit union, that's a good one. That's a good one.
Okay. People use banks because they provide a safe, insured place to store money and a convenient way to manage daily transactions, pay bills, and make purchases. Um, Different types of financial institutions: commercial banks, credit unions, online banks. And this is like going in depth of what a bank and credit union is. Okay, a bank is more advanced in mobile. They have mobile apps and technology. Provides more branches and ATMs nationwide. Tends to have stricter rules and less flexibility with customer service. Offers more options for banking requirement and investments. Makes the profit of its customers and investors. A credit union is a nonprofit institution owned by members collectively and offers less options in commercial banking, lower fees, and better interest rate on loans and saving accounts. It provides thousands of shared COOP branch locations and surcharge-free ATMs. So today we will talk about the different types of bank accounts and what they can do for you and how they can help you. Checking is used for everyday spending. It comes with a debit card and it's easy to withdraw money. You can use a checking account for paying bills and purchases, and it usually earns little or no interest. Savings is used to save money for the future, and it earns interest over time. and have fewer withdrawals allowed. And it's best for emergency funds and goals.
Okay, it's time for a quick quiz. Make sure everybody's with us. So
Okay, so which type of bank account is best for everyday spending?
we have two types of bank accounts.
Y'all can we can go back for y'all if y'all need to.
Yeah, type your answers in the chat. We have two types of bank accounts: checkings account and savings account. So which type is best for everyday spending?
Okay.
That's right. Okay, that's correct. The checking account. Now, next question. Which one provides more branches and ATMs nationwide? A bank or a credit? A credit union. That is actually not right. That's okay though. That's a learning moment. So actually, banks provide more branches and ATMs nationwide. Yeah, bank, correct. So yeah, thanks. Okay, guys, now it's time to talk about credit. So why do people use credit? People use credit to make large purchases like homes and cars without saving the full amount up front. It builds a credit history, allowing them to rent apartments, set up utilities, and secure better insurance or job terms. Additionally, credit cards offer fraud protection and better rewards. Okay, so examples of credit and why credit exists. So some examples of credit are credit card, which is very common for everyday purchases, a auto loan, and that's how most people usually finance their car. A student loan, those help individuals pay for their education, and a mortgage is basically a loan specifically for buying a home. And these are the reasons why credit exists. College, paying for college, house, car, businesses, emergency expenses. And basically just credit helps us make large purchases, fund important needs like education, grow businesses, and manage unexpected financial life emergencies that we can't always cover with just our savings. Okay, now let's go into more detail about credit cards. I know this looks like a lot, but it's really simple. A credit card is a physical or virtual payment card that lets you borrow money from a bank to make purchases. It operates as a revolving line of credit, which means that you can spend up to a specific limit and pay the money back over time and then, borrow it again. Credit cards versus debit cards. Okay, so using a credit card means using borrowed funds from a bank. And the benefit of this is earning rewards and building a credit history and getting fraud protection. While one downside of using a credit card is if you don't pay the full balance each month, interest adds up very quickly. But with debit cards, the benefit of using them is it helps you avoid debt and it usually has lower fees. But the downside is that you won't build as strong of a credit history, which is really essential. Okay, now interest. Interest is the monetary charge for borrowing money or the reward for saving it. It is usually expressed as a percentage of the principal, which is the original amount, over a specific time frame. So borrowers pay interest as a fee for using the funds while savers earn an interest on their deposited funds. So we made a quick video for you guys to really explain how this works.
Hey Carter, can I talk to you for a second?
Sure. What's up? You look stressed.
I really need to buy this new bike for my job, but I'm short this month. I was wondering if you can possibly lend me $100. I can pay you back next month when I get paid.
$100. I can do that, but I've been saving up myself, and if I leave you money, I'm not earning any interest on it.
Interest. All right, that's extra money you charge, isn't it?
Exactly. It's like a small fee for me, letting you use my money. Think of it this way: if I put that $100 in my savings account, the bank will give me a little bit extra over time.
So if you lend it to me, I have to pay you back the extra plus some extra.
Yep, it's usually a small percentage. Let's say maybe
extra $5 for a month, so you pay me back 105.
Okay, $5 extra. That's much less than I expected. I can definitely do that. It makes sense. You helped me out. And the little bit of interest is like a thank you for letting me use your money.
Oh, exactly. And for me, it's a way to earn a little something on my savings, even when it's let out. So deal 105 next month.
Deal. Thanks, Carter. You're a lifesaver.
No problem. Just remember, interest works both ways. You pay it when you borrow, and you earn when you save. Yeah, so I hope that video kind of helped explain interest a little bit more. Basically, it's just it's the fee for borrowing funds. That's basically just the simple term. So now let's go into minimum payments. So basically, a credit card minimum payment is the smallest amount you can pay by your due date to keep in good standing. It's basically just calculated like 1 to 3% of your total balance plus any interest or fees, or sometimes it's a flat fee of $25 to $35, whatever. It depends on the account. And the debt lasts much longer and costs much more because interest starts to build. So in the picture, you kind of see like if you pay the minimum on $1,000 iPhone, it says paying the minimum. It takes like 30 plus years. You will actually end up paying 13,000. So that's just kind of like a overview. Like that's with like 27% APR. So like it really depends on everything, but that's just like a kind of example of what happens when you do the minimum payment. Okay, credit limit. So credit limit is the absolute maximum amount of money the lender allows you to borrow on a revolving account. This is a credit card or a line of credit, and every purchase reduces your available credit while payments restore it. So the available credit is like the amount of money that's available, and then the credit limit is the total amount that can be borrowed. So I hope that makes a bit more sense. And then to wrap up the credit, we'll talk about credit score. So basically, a credit score is a 3-digit number, typically ranging from 300 to 850, that predicts how likely you are to pay back borrowed money on time. Lenders, landlords, and insurers use this number calculated from your credit report to determine your credit worthiness. A higher score generally indicates a lower risk for lenders, potentially leading to better loan terms and interest rates. This information is vital for financial literacy and responsible borrowing. So as you can see in the picture, very poor, 300 to 499, and excellent, 781 to 850. So that's kind of just like a visual range of where a good credit is versus bad credit. Okay, another quick quiz. I know that was a lot of information, but what is one benefit of a credit card? I talked a lot about credit, but specifically a credit card versus a debit card, if that's, jogging your memory. I think, credit cards are funds used. Credit card means you're borrowing funds from a bank. So let's see, what could be the benefit of that? Any benefits in the chat? Maybe they need a little hint. Let's see. Maybe a benefit ties into the credit score, credit history, building credit history, that could be a benefit. Any ideas? Okay, a benefit somebody said a benefit of a credit card is that if you want to buy something but you don't have enough money at the moment, you can still get it. And a score of 367 is good.
Okay, 367 is not good, but
So yeah, well, on a scale from 300 to 850, 367 is more on the lower side, and you kind of want your credit score to be a
Yeah,
bit
like
higher.
700.
The higher the number, the better.
yeah.
And that is one benefit of using credit cards. So thank you.
Fraud protection. Okay.
Fraud protection, that is a benefit.
Yeah.
That is a really good benefit. Thank you.
Okay. Bad credit habits. Here's a list. Okay. Yes,
Yes, the
367 score
score
is bad. Bad credit habits could be a list of missing payments, paying bills late, maxing out credit cards, applying for too much credit at once.
And some good credit habits are paying your bills on time, paying more than the minimum payment, keeping balances low, and borrowing only what you know you can repay.
Why credit score matters. A good credit score can help you rent an apartment, buy a car, buy a home, get lower interest rates, and apply for some jobs.
So some key takeaways from today are what banking is, the types of bank accounts, what credit is, and how your credit scores work. So I hope this kind of helped get some more information on that. And just remember that smart money habits today create financial success tomorrow. So thank you guys.
Thank you. Any questions? In the chat, put it in the chat.
Yeah.
Thank you.
Thank you.
I have a question. What is better to use a credit card or debit card?
That is a great question. I think as a teenager, since you're starting to learn more about financial literacy and get better spending habits, I think it's better to you can get a credit card now to start building up your credit, but I think it should be under a parent so they can help monitor it, and so you don't do reckless spending and end up with a bad credit before you're able to even start paying for things. Thank you for the question.
So actually, like you gotta be under a parent. You can't get a credit card yet.
Only when you're 18.
18 and up.
older. But
Yes.
you can get a credit card under your parent now so it can help you build your credit history for later. Thank you guys.
Be sure to see us or watch us live on Worksite Wednesday and Bright Future Friday and the next Monday.
Thank you.
Thank you.